Good afternoon, and thank you for joining this KFI webinar, Fed in Flux, how the banking sector will be impacted. While all attendees have joined in listen-only mode, we encourage you to engage with our presenter through the Q&A feature on your control panel. To learn more about KBRA Financial Intelligence, simply scan the QR code on screen. Should you have any additional questions on the topics discussed today, we are always available for a follow-up call. Now, I'd like to hand things over to KFI's Associate Director and Head of Research, Sean McGovern, who will lead today's presentation.
Hey, good afternoon, everyone. As you heard, I am Sean McGovern, Associate Director here at KBRA Financial Intelligence, and I'll refer to that as KFI very often. That's our acronym we like to go with. So if you hear KFI, KBRA Financial Intelligence, that is the same thing. My main responsibility here at KFI is heading up our research outputs, and we call that our insights, where we tackle big macroeconomic ideas, kind of things that are changing in the economy, whether that's data, regulation, politics, all of that. It all flows downstream to the banking sector. And we want to make sure that we are informing our clients and non-clients, actually, informing everyone how exactly the banking sector is going to be impacted by the goings on in the world. And we use our data sets that we have within KFI to do that. We'll go through kind of what we have in a minute, but I want to let you know that if you're an Insight subscriber already, you'll probably be familiar with a lot of what we talk about today. You might recognize charts and concepts and things like that. This is really months of work that has been put into a single presentation, boiled down into something digestible here, single presentation. But if you're interested in the stuff we talk about today, the concepts, the data, you can subscribe to KFI Insights for free. You just go to our website and sign up, and you'll get it straight to your inbox. So getting into just an introduction to KFI. I know we have some familiar faces here, some people that know us well, some clients, but I know we got some new folks as well. And just to let you know who KFI is, we launched in 2020 as a data provider for nearly 10,000 US banks and credit unions, combining our proprietary KFI scores with comprehensive banking data for peer benchmarking analysis and to help manage counterparty risk. And those are going to be our two big use cases, right? Peer benchmarking, counterparty risk. And that's going to be useful for not only banks and financial institutions, but also large depositors as well. And you can see we have a pretty wide spectrum of clients here. And that's because our platform can be useful to many people due to the number of data sets, due to just all of the things that we have, right? And I mentioned those KFI scores. That's going to be our proprietary scores. Second here. Those are going to be scored on a scale of A, B, C, D, E, and we have that for all 10,000 banks and credit unions, like I said. That'll correspond to strong, sound, adequate, and weak financial condition. And now when you get into the D's and E's, that's the weak financial condition. Our analysis shows 96% of banks that failed from 2010 through 2024 had a KFI score of D or lower prior to their FDIC date of failure. So that's going to pull in that call report data to score all of the institutions, credit unions, banks, and bank holding companies as well. 3 different models for those. If you're interested in your bank's KFI score, your credit union's KFI score, reach out to us. We can help you out with that. And we can talk about that more at the end as well. But I also want to just talk about our data sets here. And you'll see these used throughout this presentation. This presentation is largely built with our data sets, like the call reports that I mentioned. We also have UBPR for the banks, bank holding company reports as well in the FRI 9C, but we've got those call reports for the banks and credit unions, gap filings for the publicly traded guys, KFI scores, we talked about, summary of deposit data that hydrates a nationwide map of bank branches and the deposits at those branches, M&A data, which is going to be maybe more useful coming up here very soon with a little bit of an uptick in M&A happening, enforcement actions, Community Reinvestment Act or CRA ratings, and our macroeconomic and demographic data. So that macro data, that's going to factor heavily into what we work on, what we work with today. Lots of macro focused stuff, and KFI is great because you can cross-reference that with your bank data right in our platform. Of course, I mentioned our KFI Insights, which we'll play heavily into today as well. Our 3 delivery channels, web app, Excel ad, and data feeds. And I'll show you at the end exactly how I make all the charts and the stuff that we go through today. But without further ado, I do want to jump into our content, answer one of the big questions that everyone is wondering, where is US monetary policy today? As most of you will know, the Fed did reduce its federal funds rate by 25 basis points at the September FOMC. That was a couple weeks ago now. On September 17th, that decision was made. And they also projected 2 more cuts by the end of the year. And that when we talk about a rate cut, we're generally going to be talking about 25 basis points. They can be larger than that. But generally, we're looking at 25 basis points as the norm for rate cuts. And I'll specify if there's anything that we talk about that's bigger than that. The Fed remains on a pretty gradual easing track, right? If we go back to 2007 and we go back to 2019, we can see a similar shape kind of forming for what monetary easing looks like in the 21st century. And it's not really what the Fed would want, because you get that increase in rates and then you get a pause. You have the easing that starts and then another pause, and then rates kind of start to crater towards zero. That is not what the Fed wants. The Fed wants to get toward the neutral rate and find out where that is. And they have projections for where they think it is and where they want to get to. But in the last couple iterations of easing, they missed that. They were too tight, or something else happened in the economy. Like in 2020, you had COVID-19, right? That kind of messed up their plans and they had to cut to zero and start a big QE operation. They don't want that, needless to say. But that is kind of what's defined easing in the 21st century, going back the last 20 years. Not a lot of people remember what it feels like to actually have a successful easing cycle where you get that soft landing. We're in a pivotal point right now in that second leg of easing. And we're 12 months into the easing cycle, which is a significant time as well, because when the Fed has started easing in these last 2 cycles, 2007 and 2019, rates ended up at effectively near zero levels, less than 16 months on from that first cut. So we're in sort of the period of trepidation here, seeing if the Fed really is managing their easing correctly. Now, if we just look at what the Fed's doing compared to some of the central bank peers around the world, it's been a pretty moderate path, right? You look at the last 12 months, compared to the Bank of England, Bank of Canada, European Central Bank, Swiss National Bank, the Fed's kind of middle of the road there, right? A little bit more easing than we've seen at the Bank of England, on par with Canada, but less so than the ECB and the Swiss National Bank. The Fed will probably catch up to the ECB and the Swiss National Bank, one, because the ECB is not cutting anymore, or they don't have any plans to in the near term. And the Swiss National Bank's already at 0%. They might not want to go into negative interest rates again. They may if they have to, but they want to avoid that. So the Fed is going to play a little bit of catch up there probably over the next several months through the end of the year. So that's where we are today. And if we want to look into the future a little bit, 2 things happened at the FOMC meeting this month. One was that we got that 25 basis point rate cut, very big deal. But I would say that that was already kind of expected, right? What we didn't know going into that meeting was what the summary of economic projections would say about the future. The summary of economic projections comes out 4 times a year after an FOMC meeting. So you get them in March, June, September, and December. And this year, the difference between what was going on in June and what was going on in September was huge. So by the time September rolled around, those June projections were really out of date, right? It was just so much happened with the data, big revisions to job numbers, things like that, that those June numbers were super out of date. And everyone wanted to see, okay, where is the Fed going to try and adjust interest rates through the end of 2025, as well as future years, but really 2025 was the big focus. If we look at the top chart there, what that is Fed watch probabilities for the Fed funds rate at the end of the year. Fed watch is a great data set by CME that takes the probabilities of changes to the Fed rate as implied by the 30-day Fed funds futures prices. So kind of looking at what traders are pricing into the market. And generally, what we saw was that before the Fed made their decision on the 17th and after on September 29th, yesterday, the numbers are pretty much the same. There's not really a whole lot of change. So the Fed followed a path generally that the market was already expecting. You did see some of the most dovish bets come off the table there, because that went from 3.6%, that probability of going to the 3.25% to 3.5% range, that came off the table. It's looking generally like most market participants are seeing a pretty good chance for 2 more rate cut. I'm sorry, from 3.75 to 4% through the end of the year, but the consensus is kind of forming around 3.5 to 3.75%. And remember, we are at 4.25% as the upper limit right now. If we look more closely at the summary of economic projections, we're going to look at the median first. And actually, I'm going to pull out my laser pointer here so you kind of know what I'm talking about. This is a really big table with a lot. This section here is the median, right? And 19 policymakers actually take part in putting these projections out. 19 FOMC policymakers, 7 are going to be from the Federal Reserve Board of Governors, and the rest will be Federal Reserve Bank presidents from around the country. Only 12 of these policymakers actually vote on interest rate policy, like do we cut, do we hike, what do we do with interest rates? But 19 actually go into these economic projections, which go through all the way through 2028 and down through the longer run, which I'll explain what the longer run actually is, but you can see we have different projections for every year. And if we look at GDP, that's one of the big ones in here. Generally, the change from the June projection, remember, we're looking at September projections and we're comparing those to June. GDP expectations have gone up, right, for each year going out to 2027. These are the first numbers for 2028, so you can't compare them to June. September was the first time we got those. But for GDP, generally, the median policymaker at the FOMC is feeling better about growth. They're also feeling better about unemployment. For 2026 and 2027, the unemployment rate projection was moved down. When we get to PCE inflation, so that core PCE inflation number specifically, that is the Fed's preferred gauge of inflation. Pretty much the same for 2025, but moving up a little bit in 26 versus what they had previously expected, all the way down to 2% in 2028, right? So the Fed does still see itself on a path toward that 2% inflation target they want to get to. Now, it's going to take a little while to get there, obviously, but there might be a little bit more bumps in the road when we talk about 2026. And that could be due to the fact that they are expecting to cut rates. Maybe the Fed has 2 mandates, right? And if the Fed is cutting rates to kind of accommodate their need to maximize employment, they might have to give up a little bit on the inflation side, if you know what I'm saying. So there might have to be a little bit more inflation in 2026 to accommodate the employment mandate. But ultimately, even with the rate cuts, they do see themselves getting back to that 2% inflation. And now for the big one, federal funds rate. That was a change for every single year going out to 2027. We went from an upper limit of 4%, because remember, the Fed does these rates, they do it within a range. So 3.75 to, or sorry, from right now it's 4% up to 4.25%. And so that upper limit for the end of the year was 4%. Now it's down to 3.5%, 3.75%. So adding a rate cut. They also added another rate cut in 2026 and then another one in 2027. Right. So we see ultimately getting down to 3% over the longer run. That's where the Fed wants to be. That's kind of where they might see the neutral rate at 3%. Now, that longer run, that's not really a period of time. Obviously, it's further out than 2028 if you want to put some kind of time period on it. But what the longer run really means is that in an ideal scenario, that's where the Fed wants it, right? In an ideal scenario, it's not really a measure of time. It's more a measure of what the Fed wants to get something like a soft landing, right? So we have those medians, but we also have the ranges. And for growth, unemployment, and inflation, the ranges didn't change much. They were all kind of normal, kind of following what they were before, a little bit of a move down in unemployment, things like that. The Fed funds rate range, though, however, that's where you see something very interesting, where we went from the bottom of that range being 3.75%. So the most dovish policymaker was saying, yeah, by the end of the year, 3.75%. That was the most dovish member, all the way down to 3%. So how did that change? How did that happen? Well, right before we started this meeting, before we started the FOMC meeting this month, Stephen Myron, who's actually the chair of the council, the President's Council of Economic Advisors, was added to the FOMC, was added to the Board of Governors, and therefore he partook in the FOMC. And it's very likely that that was him. He is the 2.9% number, which, by the way, if you look at that number in terms of where we are now at 4.25%, that's going to be 125 basis points of rate cuts by year end, which is very unlikely, right? Very unlikely. But that just shows that he's a pretty big departure from virtually anyone else on the Fed Board of Governors. And we know it's him most likely because he was the only dissent on the choice to reduce interest rates by 25 basis points. He was the dissent, but not because he thought we shouldn't cut at all. He was like, actually, we should cut by 50 basis points. So he wanted a bigger cut than what actually ended up happening. It's very likely he's at the bottom of this range here, especially because it's such a big change, and he was the biggest change at the FOMC. Now, he didn't impact the ranges of the other data, right? And so he's kind of seeing the economy in line with what the other policymakers are seeing. He just seems to want lower rates. And who else do we know out there somewhere, maybe in DC, wants lower interest rates, and he wants them lowered by hundreds of basis points? Well, it's going to be the president, right? We know that Donald Trump is very dovish. He's very dovish, probably more vocally dovish than any president that at least I've ever seen, talking about specific numbers, right? He wants rates cut by hundreds of basis points. He thinks we're the Fed funds rate is way too high. And he nominated Stephen Miron to join the Board of Governors not too long ago, actually. Stephen Miron, as I said, just joined right before the meeting, right? And actually, I do want to ask a poll question really quickly before we get into this. I want to get you guys involved. We have our first poll question here before I jump into the Fed composition. How much further will the Fed lower the Fed funds rate through year end? And we have a few choices here. We have 0 basis points, so no cuts. 25 basis point will be 1 cut. 50 basis points, and that should be 75 basis points or more. But I guess technically 57 is more than 50, so that should be 75 basis points or more. But nonetheless, those are your 4 choices, and I'll give you guys a couple of minutes to vote on that. Actually, I'm going to vote too. I didn't realize I got a chance to vote here. This is going to be fun. All right. I think that is enough time. Let's see, do we get the results there? 25 basis points. So our audience here is a little bit more hawkish than the Federal Reserve is, or at least the median policymaker is much more hawkish than Stephen Miron. So thank you for your answers there. By the way, these are all anonymous, so you can, give us answers, and we don't know who you are or anything. So as I was saying, though, so Stephen Miron, he was appointed to the Board of Governors by Donald Trump, approved by the Senate right before the FOMC started. Actually, the second fastest approval ever for any FOMC governor. I'm sorry, Board of Governors at the Fed. That could precede further changes. I mean, we've already had a couple, right? Donald Trump, not only has he put Stephen Miron on the board, he also successfully nominated Michelle Bowman as the vice chair for supervision. And coming up next year, he will be able to replace Federal Reserve Chair Jerome Powell with a new chairperson. And, there was some whispers that maybe he would go as far as firing Jerome Powell, but it really wasn't worth it. That would set off a pretty big legal battle. A little bit of foreshadowing there. Set off a big legal battle. It's just not worth it. The amount of time, May 2026 is coming up very quickly. And it's also likely that Powell could step down from the board totally. He could remain on as just a governor through January 2028. But his last 2 predecessors, Ben Bernanke and Janet Yellen, both of them, when their time as chair was up, they stepped down from the board totally. And so that's kind of more common that you see. It's a little bit weird for the chairman to get relegated just to a regular governor position or even a vice chair position. So you have Jerome Powell on the hot seat. Stephen Miron's actually on the hot seat too, because his term only runs through January. He's filling in for Adriana Kugler, who resigned. She was a Democrat. He's a Republican. So whoever takes over for Stephen Miron could be the next chair of the Federal Reserve, and that's probably how they'll do it. The other big consequential move here is Donald Trump's attempted firing of Lisa Cook. He issued an order to remove her on August 25th. That was blocked by district court in DC, who said that his reasons for removing Lisa Cook it didn't seem like it stood up to the requirement that for a president to fire a governor, it has to be for cause. Now, that is a ambiguous legal term, which we'll talk about a little bit. But the point is that Lisa Cook is on the hot seat. You got Powell and Cook on the hot seat. Miron will also be replaced, but with a Trump appointee. And if you think about what that means, You also have Vice Chair Philip Jefferson. His term as vice chair ends in September 2027. By early 2028, if the Trump admin, they run the table, they get everything they want, the Lisa Cook firing is moved forward, all of that, Trump may have nominated 3 new governors, both vice chairs, and the chair of the board of governors, right? And so you have a very vocal, dovish president, and with a lot of increasing influence over the Federal Reserve Board of Governors, which all of them are always voters at the FOMC, and just generally are influential. And they also vote on bank regulation. The Fed is a national bank regulator, federal bank regulator, and they pass different kinds of rules about supervision, capital requirements, things like that. So not only does the president have increasing influence over the path of monetary policy, or he could, also over the future of bank regulation as well. Now, I want to talk about the Lisa Cook case because, as I said, a court has blocked Donald Trump from firing her for now, but that could change. That's been moved up to the Supreme Court, right? And I'm not a lawyer, I'm not a constitutional scholar, but I think it's important to discuss the precedent here and how what might really be at stake, or at least what is the court deciding right now. So when it comes to getting rid of agency heads, if the president wants to fire someone who is an agency head, if it's a unilateral director at something like the CFPB, the Consumer Financial Protection Bureau, there's just a single director. The president can fire them at will, no need for cause, right? And that's what happened, or that was decided in 2020 in a case, Saylor Law versus the CFPB, which challenged the removal protection of the CFPB director, which to that point had only been allowed for cause. But then there is a precedent called Humphrey's Executor, and it's been around for 90 years. What that essentially says is that unilateral agency director can be removed, but if the agency heads are on a board, a committee, any kind of group of commissioners, any kind of grouping, it's not a single unilateral head of an independent agency, there has to be cause even for the president to remove them. And if you go back to that 2020 case, what's very interesting is that in the dissenting opinion of Justice Elena Kagan, she mentioned the Federal Reserve Board, the Federal Trade Commission, and the National Labor Relations Board, so the FTC and the NLRB, as places where the court has commonly allowed branches of government to create zones of administrative independence by limiting the president's power to remove agency heads. Fast forward 5 years, and President Donald Trump is trying to fire a member of the Federal Reserve Board, a member of the Federal Trade Commission, and the National Labor Relations Board. And with the other 2 cases, so you have Trump v. Wilcox and Slaughter v. Trump, these are the FTC and NLRB cases, the Supreme Court has stayed rulings that said Trump could not fire those workers. So the Supreme Court does seem to be allowing the president to go forward with these firings of these committee, commission, board members while the cases are adjudicated. And that's what Lisa Cook's case is dealing with right now at the Supreme Court. The president is requesting a stay of the lower court's ruling that he could not fire her. So if that stay is granted, Donald Trump could move forward by putting a new governor on the Fed Board of Governors while the case is adjudicated. And we don't know what the outcome will be. That's really a far way away. But right now, what's being decided by the Supreme Court is whether they will put a stay on that ruling like they have with Trump v. Wilcox and Slaughter v. Trump. So that's kind of what's going on. And that's where the court is now. It seems like maybe Humphrey's Executor, that is losing its vitality as precedent. We'll see what happens. It's very up in the air, but this does have the makings of a landmark case, and you should follow KFI Insights for updates on this. We will update this as time goes on, because as I said, huge implications for monetary policy, bank regulation, and for just what's going to happen in the market. The market will be pricing this in as it develops. So you want to be completely updated on that constantly. So we have all that. We have where the Fed is, where monetary policy is, what could possibly change at the Fed. right? But we should also start talking about the macroeconomic data. So I'm going to talk about GDP here and how that's been developing, and then we're going to jump right into the bank data after this. We're going to get into the call report data and talk about how this economic situation is impacting banks. So GDP growth showing signs of strength. US GDP growth rebounded from a 0.5% decline in the first quarter of the year to a 1.9% gain in the second quarter. Now, these numbers are a bit unreliable. If you look here in the top chart, I've mapped out the four contributors to GDP. You have personal consumption expenditures, which is consumer spending, gross private domestic investment, net exports, and government consumption expenditures and gross investment. So we'll just say government spending. So those are the big four components of GDP. And in the first quarter, you can see that net exports just crashed, right? Whereas gross private domestic investment shot up. And now in the next quarter, the second quarter, it's the opposite. Well, what's going on there? Because of the tariffs, a lot of demand for imports was pulled forward. And because of that, that drove down the net exports component. Actually, exports as a whole were at a record high in the first quarter of 2025, but the imports rose so quickly that the net exports component of GDP just like crashed. And gross private domestic investment, that shot up because as those imports were coming in, inventories were getting built up, and inventories are a part of that component. So you see in the next quarter, it goes back the complete opposite direction, right? And so that's a bit of a distortion. You also have government spending for the first time in several years, going back to 2022. Government spending is not adding to GDP. It's actually pulling GDP down. And that's because government spending is starting to decline. So those are three big changes that kind of obscure our understanding of what does the private sector really look like. Well, there's a great measure out there called private domestic final purchases. That's PDFP. And if you just wanted to kind of put that in instead of the GDP, it was 2.5% in the first quarter and then 2.9% in the second quarter. That sounds a lot better, right? That sounds a lot better than negative 0.5 and then 1.9%. And that's one way you can represent just let's see the private sector. Let's take out the government spending. Let's take out the inventories. Let's take out the net exports. PDFP is a great measure for that. And that suggests we have pretty solid sustained growth. I think the tariff related distortions will begin subsiding as we get into the third quarter. That data will get relatively soon. I think maybe then the GDP will be a bit more reliable of a indicator of what's actually happening in the economy without distortions. Now, one way we can sort of look into the future is a number from the Atlanta Federal Reserve Bank. That is called the GDP Now. They issue a nowcast for every quarter. They start the quarter with projected figures, and as the data starts to come in, they update and update and update. And throughout this quarter, this is the bottom chart here, the third quarter data is looking better and better and better if you're just looking at the GDP. They started out around actually 2.4%, and the latest GDP nowcast is up to 3.9%. So a 3.9% number on the GDP, that would be very significant. And we want to break that down as well. This is where we're going to start getting into the banking stuff, right? Like really specific banking components. We have mapped out as components of the GDP now, we have the equipment, PCE, non-residential structures, and residential investment. Equipment is very strong as implied by the GDP now. That's adding 7% to the GDP now. And when you think of equipment is often financed, right? So any kind of equipment financing going on, banks will probably be doing that kind of lending. That's going to be very beneficial for them. PCE, that's going to be personal spending. That's up, I think, by about 2.5 to 3%, which is great. That's going to be personal consumptions. Think of credit card lending, personal lending, any kind of that lending. Now, non-residential and residential construction, those have both been weakening for quite a while. I believe residential construction and development loans, if I'm not mistaken, have declined year over year for 8 consecutive quarters. And you can kind of see that manifesting in the GDP. So this is a way you can look at what's going to impact the banking sector, right? You break it down into sectors just like this. So now that we have a really good understanding of what's going on with economic growth, I like to look at economic growth sort of as bank lending, right? If you look into the first and second quarter of this year, as I mentioned, I mean, the first quarter supposedly the economy declined. It was weakening, is actually receding by 0.5 percentage point, 0.5 0.5%. But bank lending was up 3% year over year. So to me, that was suggesting I think there's something a little bit more going on here. I think the economy is a little bit stronger. And once again, you look at that PDFP number or other measures that the Fed uses, because remember, the Fed is looking at PDFP. That's not just the number that we're bringing up. Jerome Powell brought that up in his press conference after the June FOMC. So we know they're looking at PDFP. And since we're talking about what the Fed's thinking about, we should be looking at that. But they're also looking at bank lending, just like we are. And in the second quarter of this year, you can see we had 4% year over year growth in total bank lending, right? That's the highest that we've seen since the second quarter of 2023. We also have a rebound and stabilization of net interest margins. So if you're not familiar with that terminology, I know we have a lot of banking people, but I think we have some people that might be a little outside the banking space. The net interest margin is simply going to be the difference between what you're making on your lending and what you're paying for your funding, right? And as you had what we would call an inversion of the yield curve, where the shorter term rates are higher than the long term rates, that basically puts banks upside down, or banks were upside down. We have a steepening of the yield curve now, but before, throughout 2022, all the way through most of 2024, you had a very difficult situation for banks, because banks, they borrow money at the short end of the curve and they lend at the long end. So how do they deal with that? Well, we'll talk about that. But now we're seeing that steepening of the yield curve. And as that yield curve is steepening, we're seeing a bounce back in those net interest margins. That's going to boost bank profitability, or at least their lending profitability. Banking industry net interest margin does remain a net 12 basis points below the fourth quarter of 2022, which was a recent peak. But you can see there it's stabilizing, it's rebounding, and that's generally positive for banks. And if we look at the 10-year Treasury yield and the 2-year Treasury yield, so a short-term rate versus a longer-term rate, you can see that both of them are kind of moving lower. The 10-year and the 2-year both moving lower, but the 2-year is moving lower at a faster rate. So that is steepening the yield curve. Generally, the 10-year can be expected to come down as the short-term rates come down. The 10-year is going to be more influenced by the bond market, though. It's going to be influenced more by growth and inflation and things. So even as it comes down, or if it continues to come down, as long as the 2-year or the 3-month or even the Fed funds rate comes down faster, you get that steepening of the yield curve. Despite emergent recession fears in late 2024 to early 2025, loan growth held its ground, bounced back with only a moderate increase in delinquency. And that's probably the most encouraging sign in the banking industry right now, is that, yeah, loan growth is up. Profitability is up, but generally speaking, delinquency has not moved up a whole lot. And I think in the second quarter, delinquency in several categories of lending actually went down quarter over quarter, which is encouraging, right? We're going to move on now to the inversion ends as steepening resumes. So very similar to what we talked about in the last slide. We're going to use the term soft landing. I don't think it's as controversial to talk about soft landings anymore, right? I mean, we've been hearing that term for a couple of years. Kind of the soft landing is just the Fed getting to where they want to be, where they can raise interest rates, hold them, get inflation under control, then start easing without causing recession, without any serious problems erupting in the economy. And that could potentially buoy or even boost those long-term yields. In our top chart here, we just mapped out what's going on with the Fed funds rate in the 10-year from March of 2024 to now. And you can see when the Fed first started cutting rates, they cut by 50 basis points, which kind of scared everyone. That was a bit of an aggressive move there to start their easing with 50 basis point rate cut. Generally, rate cuts are done in 25 basis point increments unless there's something serious going on. So it surprised everyone. And you can see the 10-year responded by also moving lower significantly, because the expectation might have been, uh-oh, the Fed's moving really fast again. Maybe there's a recession imminent, maybe, and that would drive down the 10-year, right? As lower growth, generally, you're going to get a lower 10-year yield. However, once we got into a more gradual pace of easing, right, it was 25 basis points, and it wasn't every meeting. There were breaks and pauses. The 10-year started bouncing back. It looked like the Fed had a better control, or has a better hold on the economy, right? And we're only getting now out of that inversion of the 10-year and the Fed funds rate, that we're only now just starting to get out of that. The Fed's current projected policy path suggests that the Fed funds rate would still need to be adjusted lower. So if you get the 10-year kind of moving sideways or even slightly down, as long as the Fed is reducing rates faster than that 10-year is coming down, or if the 10-year is holding steady, you're going to get that steepening of the yield curve that we're talking about. Now, how steep can the yield curve really get if you just compare the Fed funds rate and the 10-year yield? Well, we don't know exactly, right? We can't predict that yet, but we can look at history and we can say, well, what is the historical kind of spreads that we've seen in phases of monetary easing? And if we look back at the last 6 instances of easing, and the spread between the 10-year and the Fed funds rate, it can be as wide as 380 basis points, or it can be as narrow as 113 basis points. And that all depends on the rate of inflation, GDP, and just how quickly the Fed is cutting rates. If you have a strong, the mixture you need to get that like 380 basis point spread is really strong growth, maybe higher inflation than the Fed actually wants. And then still, though, those Fed cuts that are bringing down the short end of that yield curve and the growth inflation, that's pushing up those longer term yields. Continued yield curve steepening likely to take place if the Fed's projections for growth and monetary easing are realized. Because remember, the Fed is pretty positive about growth, and their inflation projections do see inflation running above that 2% target all the way out until 2028. Such a scenario would present positive prospects for bank loan growth and net interest margins, as we talked about. Now, next thing we're going to talk about is sort of stock market, equities, bond market stuff. But before we get into that, I want to ask our second poll question here, if we can pull that up. Within what range do you expect the 10-year Treasury to land at year end? We've got 3.5% to 4%, 4% to 4.5%, above 4.5%, or below 3.5%. And just as a point of reference, we're somewhere between 4% and 4.1% right now. Obviously, you guys know how significant that 10-year is. And we came close to 5% not too long ago, got close to that 5 handle. Will we hold on to the 4 handle here, or will we be heading lower? Give you guys a couple seconds to get some answers in. All right, I think that's good. Can we get our responses, please? 4.5%. So in that range where we are currently, definitely about a third of you think 3.5 to 4%, so a little bit lower. No one below 3.5%, but we do have someone, 2 people actually above 4.5%. So probably seeing a little bit stronger inflation there, a little bit stronger growth, maybe something else. If you want to ask any questions related to these poll questions, if you want to get, further thoughts from me, you want to like bounce something off of me, whatever you want to do, please feel free to ask those questions and just put something down, and we'll talk about it at the end if you want to expand a little bit on your answer there, because definitely some interesting answers today. As I mentioned, all this data here is going to be available in our platform as macroeconomic data. But our next slide, this is going to be stuff that's available in our platform as GAAP data or SEC filings. We have the 10Qs in there, things like that, right? We're going to talk about equity and net debt issuance, which are generally getting stronger. Bank equity valuations surged back from that April low. Remember when there was all kinds of confusion and fear in the market about the tariff impact, what's it going to do to growth, what's it going to do to inflation. Generally, what the Fed is kind of saying, or at least if you listen to Jerome Powell, who's the chair of the Federal Reserve, he's kind of saying that the inflationary impact of the tariff seems to be less than what they feared. Based on the numbers we went through for GDP growth, GDP looks pretty strong. The market cap has surged for U.S. bank stocks by $1.3 trillion between April 4th and September 17th. So you can see a really strong comeback there for those equity valuations. And additionally, weighted average basic shares outstanding increased 5.1% quarter over quarter into the second quarter. It's a pretty strong increase. That means that companies are generally feeling confident about issuing stock right now. They're raising money, putting more equity out in the market, and they're not doing a lot of buybacks either, right? We can just see that weighted average number that is rising. We look at debt holdings, similar kind of pattern. Long-term debt holdings rise at the fastest rate in more than 2 years as rates decline. So feeling more confident about raising money now that the rates are starting to come down. Now, this could continue. This could kind of ease off, right? Maybe there were a lot of firms waiting to raise some cash, and they're just trying to get ahead of it, right? It's kind of an open-ended question, because if you're expecting more mergers and acquisitions potentially coming down the line here, mergers and acquisitions slowed down significantly in 2024. If that were to pick up, you might see more long-term debt issuance, right? You might see more long-term debt issuance, so banks can raise money to do acquisitions, things like that. Up 6.2% in the second quarter of 2025. And also, something else we should talk about is that these equity valuations could continue to move higher if we get that yield curve steepening that we're talking about, more profitability. But something I don't see a lot of people talking about is how much banks have provisioned as loan and lease losses, right? When banks put those aside, they sort of put those reserves off, they provision revenues for that. That's an expense when you put that in as a reserve. Now, there's $200 billion of loan loss reserves on bank balance sheets right now. As they start to release those reserves, which they may do if they feel, oh, the economy's stronger, rates are coming down, there's more opportunities to refinance any loans that might have been at risk of falling into delinquency or non-accrual, things that might have been otherwise charged off, we can refinance these at lower rates potentially, right? The economic outlook looks stronger. We don't need to put aside as much as we have for provisioning. What happens when you reclaim those, you release those reserves from the loan loss reserves, that becomes profit, right? That can boost your net income. That can boost the earnings per share of companies that are reporting those figures, right? Those publicly traded companies. And thus far, EPS has been pretty stable. And we'll talk about how banks have maintained their profitability despite that net interest margin compression. But they also have been putting aside a lot of provisions, right? Which now can be reclaimed back. If you go back to 2021, 2020 to 2021, you had a big amount of provisioning for COVID or anticipated COVID losses, which did not really materialize, largely because the Fed became very accommodative and you had all this money printing and everything. And so the banks had put aside so much money for loan loss reserves, and the economy suddenly got a lot better. They were able to reclaim $50 billion of profit, and that boosted EPS for many banks that would have had, good results. But when you were able to reclaim those loan loss reserves, that pushed their EPS, net income, all of it looked so much better just because they were bringing money that they provisioned out of the reserves. So that's something to watch for, because stocks are moving up significantly, but banks may be positioned to kind of have that trick up their sleeve. They have this money kind of sitting on the sidelines, which can be reclaimed as profit. So we have that. Last thing I want to talk about here with the banking industry relating to the Fed, we know that the Fed has changed their expectations for monetary policy, largely based on what's happening with employment, right? There's been some big changes in the job market. There's been some big changes to jobs data. And what does that look like for banks? And we kind of have a tale of two different paths here, almost mirror images, if we look at commercial banking and credit unions. We haven't talked a lot about credit unions today, but we're going to talk about them here just because there's a really interesting kind of dance going on here with the credit unions and the banks, right? Commercial bank headcount. This is disclosed in the call reports. As I mentioned before, we have these call reports. This is one of my favorite parts of the call reports. I don't think a lot of people realize that this is there. I don't see a lot of people talking about how you can look at the full-time headcounts, right, in the call reports for specific banks, but we have that. U.S. commercial bank headcount has fallen in 8 of the last 9 quarters. By contrast, credit union headcounts have been expanding throughout that entire period, actually moving to all-time highs. Now, you have a lot more commercial bank employees in the economy than you do credit union. I think credit union employment is around 500,000, whereas commercial bank headcount is somewhere between 2 and 2.5 million. But nonetheless, total mirror image here. Since the first quarter of 2023, commercial bank employees, that figure's fallen by 3.5%. Credit union employment is up 3.3%. Now, why is that happening? Why do we have this bifurcation of, effectively the lending industry, like in terms of headcount? I think it comes down to rate sensitivity. I think the credit unions have benefited significantly from very high interest rates. When you're talking about a mortgage at 3%, a difference of 15 to 20 basis points or something like that, the difference you might get between a bank or going with a credit union, it really doesn't matter as much, right? Or at least that's the psychology. If you're thinking about a mortgage rate at 6 or 7%, you're going to be a lot more sensitive to a few basis points here or there. That's going to be something you're thinking about more. And you can see actually throughout the period where interest rates were at their highest, they were rising the most aggressively in 2022. Sometimes credit union lending was rising at double the rate of the commercial banks there. You can see in the fourth quarter of 2022, credit union loan growth was 20% versus less than 10% for commercial banks. Now we have an inversion of that has changed course now, where the bank's loan growth is now exceeding credit unions. And I don't think that necessarily means, though, you get an inversion of the employment trends, though. There's it's a bit more complicated than that. A lot of the reason that the banks were reducing their headcount was not that they were in trouble financially or anything. They were protecting their margins, right? As those net interest margins were getting compressed, they were making less from lending. You have to protect that margin by taking the cost. Your costs, your expenses have to come out of somewhere else. And there were probably just a lot of employees that might have been redundant, might not have been necessary anymore. You have technology coming into play. You have AI at a lot of the biggest banks. Because remember, the biggest banks, they employ the most people. They might have some kind of disproportionate share of this decline in employment. And this is something we analyze. If you're interested in following these trends, like what's AI going to do to commercial banking, how does it change every quarter, and which banks are cutting the most jobs, adding the most jobs, same thing for credit unions. We analyze all that in our insights. So if this is something that you find interesting, please stick around and sign up for our insights, because I will continue to cover this for sure. But that interest rate sensitivity we talked about, that seems to be fading, or at least, commercial banks are seeing more loan growth than credit unions are year over year. There could also be a base effect at play there, that the growth was so strong for credit unions now that you're having a base effect kind of making the growth look smaller than it is. So a few moving parts there, but even with that reversal, I think maybe this like 70,000 jobs net that we lost in the commercial banking space, they may not be coming back. There may be technological innovation that is just, making that workforce, necessitating that workforce being smaller. And we'll see what happens with the credit union headcount. But thus far, they just keep making new all-time highs every quarter, really. So defying what's happening in the broader jobs market there in the credit union industry. So that's kind of everything I have for content here today. We walked through monetary policy. We walked through what to expect going down the line. I got your expectations as well. We talked about the call reports. We talked about GDP, breaking that all down, comparing what the Fed is thinking about to what's happening in the economy, what might continue to happen, equities, bonds, all that stuff. Please, if you have any questions, keep sending them in. We've got some time here for a Q&A, and I'm really excited to get to that. But if you will indulge me for 2 minutes, I do want to show you exactly how I made this report happen, right? This is our data wizard that we have in KFI. All I have to do to get all the banks, because I do macro level stuff, I just say I want all the commercial banks, savings loan association, whatever you want, that reported assets for the first quarter of 2025, right? Right there, I've got all 4,480 banks, and I want all their loans too. I want to see what their total loans are for the last 16 quarters. So we go back 4 years, add that, there we go. All of the banks in the country, I've got all of their total loans for the last 4 years, and I can put that right into Excel in a couple seconds. And this is how I build these reports. This is how I put all this information together and get these insights that I publish for you guys. And you guys should get this too. This is really, really helpful, easy to use, and it's all according to a matrix formula there. And I also want to talk about our macro data. Our macro data is super useful. As I said, we have GDP, inflation, anything you can think of in terms of pulling from the Bureau of Labor Statistics, Bureau of Economic Analysis, all of these different great data sources. We put that right in KFI so you can compare it with the bank data right there, cross-reference it, download it into Excel. You don't have to go anywhere else. You can just do it right in KFI. We also have a couple of different setups here where you can just have the money supply, federal funds, target range, just a whole view of public debt, how that's going to impact yields, new home supply, housing, construction, all this stuff. This really complements the banking data well, and I use it often. With that, I want to get to the Q&A. Just want to thank my support team here at KFI. You know, I'm the research guy, but we've got fantastic people on the tech side, got a great team, makes it all work. And I'm really excited to hear from you guys. I hope you reach out to me, reach out to any of us, really, all of us would be excited to hear from you afterwards. If you want to talk about data, you want to talk about our platform, whatever it is, please reach out to us. And with that, I will jump into the Q&A here if I can find some. All right, let's go. First question from the audience. Do you see mortgage rates continuing to buck the trend of Fed cuts, or are those poised to finally start to reduce the inflated spread between the 10-year and a more significant reduction to rates as they should be? So kind of a two-parter there, right? So I'll answer the first part, mortgage rates continuing to buck the trend of Fed cuts. That is interesting because, as I mentioned, that 10-year, the mortgage rates, like the 30-year mortgage rate, that's going to key off the 10 years, most of you will know, right? And I mentioned growth, I mentioned inflation, but there's also an element that I don't think has played a role before, or at least not as big of a role in those longer term rates as government spending, right? We have a lot of concerns about the size of the deficit. Can the federal government meet these obligations over the long term, say 30 years, right? 10 to 30 years, is the government going to struggle to pay down, to continue servicing its debt? That drives up yields. And so that's kind of another factor you need to think about. I would say that I think because the growth trend is as strong as it is, and because bank lending, credit expansion is going as strongly as it is, I do think that mortgage rates could remain high. Now, mortgage rates, if you look at the average rate on the 30-year mortgage, it's actually hitting a 2025 low, or at least I think in the most recent week or the week before it hit a 2025 low. Now, that's still like 6.5%, right? That's not anything to really call home about. I don't think anyone's going to be rushing out and saying, oh my goodness, a 6.5% mortgage rate instead of a 7%, sign me up. Maybe some people who are motivated buyers, but people who are more content to sit on the sidelines and wait, I don't think that'll draw them in. So yes, I think that the stronger growth trend will keep those mortgage rates high, but I do think they will start to come down a little bit, maybe kind of stick around where they've already fallen to, because the most aggressive part of easing seems to have already passed. We will get more cuts going forward, but it's going to be one here, one there, and just not that many, unless the Fed changes something. Are they poised to finally start to reduce the inflated spread between the 10-year and the more? That's pretty much, yep, that's pretty much what I think I answered already. Yeah, so I think high mortgage rates are here to stay. Probably, I don't see us dropping to like, 5, 4, 3% unless the Fed really gets more aggressive with easing. So I'll move on to the next question. What other supplementary data sets do you have outside of the reported banking data? Right, so I mentioned a good platform question. You can also ask questions about our platform as well. It could be data, platform, whatever you guys want to ask. We have those macro data sets that I mentioned. One of the coolest ones that I like is our demographic data. And what we can do with that, or if you are working at a bank or a credit union, you can look at the specific areas where, if you want to cross-reference demographic data with summary of deposits data, which we just got the newest summary of deposits data. I've been having a lot of fun with that. You want to cross-reference the summary of deposits data with demographic data, you can start to see not only the deposit trends in those areas, but aging, income, commuting, all these things that kind of just show you who your market is. I think that's very important in banking, right? Especially if you are a community-sized bank, 10 billion and under, or even regional banking, but especially for community banking, you got to know your people. You have to know your people, and that's what we want to inform our clients of: is who are your people? What age are they? Where do they go? What education level do they? What's their income? What is their potential for adding deposits? Adding funding to your bank, right? Those are all very important questions, and we seek to answer those with our demographic data sets. Yeah, I think that is definitely my personal favorite. We have something in our insights just about a month ago, where we measured the impact of aging on deposit growth and found some very interesting correlations. So go over to our insights page if you would like to check that out. Can I custom build the macro analysis displayed with my peer banks? Yeah. You can do anything in KFI, really. I mean, it's as customizable as you want it to be, or a better answer is it's as customizable as you can ask us to make it for you. Because if you want to customize anything, any kind of analysis in the Excel add-in, we can build that for you if you don't feel like you want to do it. Just, you make requests to us. We have really great white glove service here. We like, knowing our clients, working directly with our clients, figuring out how are they using KFI, keeping them engaged, customizing, do whatever you guys need. So to answer your question, absolutely you can. Can you please share these slides with us after the webinar? Yep, absolutely. You will get a recording and slides after the webinar. Definitely. Yeah, come back and watch this again. I hope this was very interesting for all of you. And yeah, the slides, those will be provided. Any further questions from anybody? I see we got 2:55 here, so we still got about 5 minutes. If we go over, that's fine with me. I mean, I'll stick around until we're out of questions. I enjoy answering your questions, and I'm here. I'm here to the very end. So please continue to ask questions. Unless we don't have any further questions, that's fine with me too. I mean, everyone could use another 4 minutes of their day. We're very busy over here at KFI. So I'll just, give you guys a couple more minutes. We'll go till 3. We'll go till 3 either way. I did want to say too that just thank you guys for your time today. I really appreciated taking an hour out of the day to spend with us. I know everyone here is very busy. Hope we have hope we see you again. I mean, we oftentimes see the same names coming up for webinars, clients and non-clients, but we love to see that. So stay tuned to KFI. We're going to continue to do these at least on a quarterly basis, and we're going to update monetary policy a lot. If you want something as like a little inside baseball about what we're going to work on for our next quarter, if you're interested in digital assets, cryptocurrencies, stable coins, these are very popular kinds of topics that I see being talked about at the conferences I attend and the webinars that I go to. Believe it or not, I don't just host webinars, I actually attend them. I'm just like you sometimes. And we're going to definitely tackle those topics soon, which we've already done in our insights. If digital assets are something that you're interested in, go over to our insights page. We'll also post a recording on social. Yep. So that's also something else as well. If you don't get the email or you have trouble finding the email, because like I said, we'll email these recordings to you. You can follow us on Twitter, or X rather. I'm sorry. It's always going to be Twitter to me. I'm sure a lot of you do the same thing, but X, we will post links to it on X and LinkedIn as well. You can find us there at KBRA Analytics, both of those on X and LinkedIn. Let me see here. I think I have some more questions coming in, actually. Thank you so much for this informative session. Thank you for coming to it. I'm really happy that you enjoyed it. When is the next conference or webinar for KFI? Oh, that's so funny. I just answered that without even seeing it. Next webinar should be November 11th, if I'm not mistaken. But we'll reach out. You'll definitely hear from us if you have like I said, sign up for insights. If you're signed up for insights, you'll get everything from us about our webinars and everything like that. So that'll be our next webinar. Well done. Thank you, anonymous attendee. I see we have Sean McGovern. Thank you for the excellent advice and informative information. Thank you, Gerald McGovern. Little nod from my dad there. My parents still come to all of my webinars and stuff that I host, so thank you to my parents, or else I wouldn't be here today. So yeah, I think I see we have some more questions coming in still. Awesome. Love that your parents support you. Yes, so do I. So do I. Thank you so much. Um, where are we at here and time? It is currently 2:59. So I'll give a couple more minutes here for questions to come in if anyone's still hanging around. Glad you guys are sticking around. Really appreciate that. Yeah, just hope you really enjoyed this. I hope this was informative. I hope that not only did you learn a lot about monetary policy, you have a much better view of what's happening in the banking sector in our country, right? And also a positive view of KBRA financial intelligence and our platforms, because these kinds of insights would be very, very hard to glean without using something like KFI. You are a genius. Thank you very much. That's not canned, by the way. That's not planted. Is KFI at any conferences this year? So for the remainder of the year, we will be at the American Bankers Association conference. We'll have a booth there, the one in Charlotte. There's a couple of ABA conferences, but we'll be at the National Annual ABA Conference in Charlotte for sure, Charlotte, North Carolina, obviously. And yeah, we'll be there with a booth. So stop by and see us. I will be there actually. I will be there in person. So yeah, please stop by. Thoughts on new bank charters in the more bank-friendly admin? This is very interesting. I just got back from a conference I was at in Texas, and this was a big topic out there. As you know, Texas has more banks than any other state, and they were talking about how many new charters we're seeing kind of popping up, right? It's been many years since you saw a good number of charters, de novo banks popping up, which I think is very interesting. Because you have two different parts of things, right? Because you have the de novo banks, right? But then you also have fintech companies that are getting charters as well. They're getting bank charters, but obviously they're going to be a little bit different than regular kinds of commercial banks. So I would say that, yeah, we we do have an administration that does seem to be more friendly to banking, or at least that's what people who work in the banking industry that I talk to, they say that regulatory framework has been better, right? There's been efforts to kind of give more oversight to the state banking regulatory authorities and kind of get rid of some of the more duplicative efforts at the federal level. And generally, I mean, the bankers are happy with that. Of course, the bankers are going to be happy with that. And if you have happy bankers, what that means is that people in that sector are going to maybe feel more comfortable going out. If you worked at a bank, or you were a CFO or a CEO, some kind of executive, maybe you go off and you start up your own bank because it's just, there's lower costs of regulation and things like that. Do you do any M&A analysis for insights? Are there any tools for M&A within KBRA Financial Intelligence? Yes. We actually track the M&A deals in our monthly reports. And that's one way we're kind of approaching it, but we're going to start working on a completely new M&A report that's going to come out as part of Insights. That'll be monthly. We'll do a more in-depth analysis of, we won't just talk about, oh, these are the deals that happened. We're going to analyze trends in M&A. What were the biggest deals? What deals might not have worked out? Anything like that. We're gonna kind of quantify that, take a more macro level look at M&A, and we are and in conjunction with that, we are in the process of rolling out a really solid M&A tool right now for KFI, where you'll be able to go to individual banks within KFI and see their history of M&A. So there will be like a macro tool where you see all the deals that happened over whatever period of time that you want, specific details about that, any kind of filings related to those. But you'll also be able to go to the bank level specifically and see what deals have happened for them throughout time and things like that. So with all of that, let me make sure I'm not missing anyone here. This was excellent. Thank you. I'm really, really happy to see that. Thank you, Chris. supplementary data sets, can I custom build? Yeah, seems like we have answered all the questions. So I'm going to call it there, guys. Thank you so much. Just, I know I've said it a million times, but we are really, really thankful for you guys showing up for us. And I hope it was great. I hope to see you again. We always see a lot of familiar faces, so I do anticipate we will see you again. Get in contact with me if you'd like to ask any more specific questions about anything at all. You see my email on the screen there. You can find my information pretty easily on KFI's website as well if you'd like to. So yeah, once again, I hope everyone has a great afternoon and great rest of the week. Hope to hear from you. We're going to call it now. Have a great rest of the week.